Wendell Russell was president.
Word.
Wendell Russell.
Great. Good evening, everybody. We've got critical mass here in the room, and I know a few others are going to be joining online. Gregory is on a plane to London. He has a speaking engagement, but expecting a good turnout of people joining virtually a little later on, hopefully. Mr. Chairman, anything you want to say to start us off?
So today we're going to be talking about competitiveness, which is one of the really centers around one of our key mandates as a commission, not looking at equity, looking at incidents, looking at efficiency of administration, but also looking at competitiveness. It's really a big part of our puzzle that we're going to try to solve. So I look forward to what our participants have to say.
Thank you, sir. Yeah, so let me start off by officially welcoming Richard and Kim. You guys have seen them before. They've both been presenters to us, but they are now officially on board, signed, sealed, and delivered as contractors with the Tax Revision Commission. So appreciate it so much. Richard, of course, was a researcher on the 2013 Tax Revision Commission and has worked on, they have both worked on several other tax revision commissions around the country from their current purchase at the Urban Institute. Kim is director of the State and Local Finance Center at Urban, PhD economist, and the two of them together are a brilliant team, and we're very fortunate to have a pretty significant chunk of both of their time, as well as access to a number of other resources that we can get through the Urban Institute. It took us far longer to sort out the contract and get all the ducks in a row than I had hoped. On the other hand, it was well worth the wait. And I'll just put a lot of pressure on Richard because he's also the presenter tonight. So tonight he has to prove his worth and show us why we did it. So he will be presenting in a few minutes on the topic of tax comparisons and tax competitiveness, starting us off with some basic comparisons of how does DC compare to our regional neighbors, but then also some thoughts about what does it actually mean to be competitive? What is the point of having comparisons? What are the challenges? What are the technical challenges? What are the conceptual challenges of doing that when we're so different from our neighbors? And in the end, of course, it all comes down to what are our goals. So I'm excited to have that presentation. We are in the third week right now of a very intensive period, and I just want to appreciate many folks on this commission who have put in hours and hours and hours of attending stakeholder meetings, whether in person or online. We've had, and I'll ask Becky in a minute to give us the interim update on our stakeholder meetings and public input sessions, since that's still going on. But it's been a pretty intense period. Very grateful to those of you who have come. I also want to apologize that our sound quality, for those of you who have tried to join, and I know Glenn has particularly bedeviled you. Thank you for mentioning it, but it probably bedeviled a lot of other people as well. Sound quality on the screen was not as good as it should have been. I'm really sorry about that, particularly because we have the intention of trying to be inclusive and transparent and make visible the work of even when we're having a small group conversation, make the work of the commission available to people, whether live or recorded. We just didn't quite match that. Fortunately, we were taking really good notes. Becky's already posted some minutes from that meeting, and we'll be filling in any gaps as needed from various notes as we work to synthesize and incorporate all the great perspectives and inputs that we had. Becky, do you want to say a little more about kind of what we've been doing over the last 3 weeks and that we've seen and stuff?
Yeah, sure. So we do have a new flashy, fancy website, which holds all of the information about upcoming meetings, agendas, live stream links, and also recordings and minutes of previous meetings. And we've done, or will, as of Wednesday, we'll have done about 10 small group stakeholder sessions with 5 to 10 invited guests who can speak to their sort of the tax code experience from their industry. We've had folks from real estate, we've had progressive grassroots organizations, tax administrators, that was last Friday. We've had hospitality representatives, hospital and university representatives, because they are the largest employers in town. So.
Other than the federal government.
Other than the federal government. Yes, we have not heard from the federal government in any of our stakeholder meetings. But all that information is, like I said, on our website, and I'd say a little more than half of all those participants submitted formal testimony. Also on our website under the in the formal comment section. And we did kind of like a town hall with ANC commissioners a week ago. Last night, we did an in-person town hall at the Arc in Anacostia, and on Thursday, we'll be doing a virtual town hall. So please, everyone, get the word out. As we're hoping that'll have pretty healthy participation, and we'll probably do more town halls in June, and probably in the fall as well, virtual and in person. Yeah. Okay.
Yeah, no,
I think all the meetings have been, really good. I mean, ranging from the, social service groups through the tax professionals, to the business leaders. I thought they all were, everybody mostly, was pushing their point of view, but number one, they had specific recommendations, right? They weren't just generalized. And two, for the most part, they were cognizant that there was another point of view, which I thought was very good. You know, with a couple exceptions, I thought was very becoming of our conversations. I think it's been a good exercise substantively and certainly symbolically for us to aggressively reach out to the public, one, because our rap is that we're just a bunch of business insiders, like we're the business roundtable masquerading as a public policy thing. And then two, because we're actually really using this commission as a teaching moment for the community, which I think is important. So.
And we have a running list of all the various ideas that have been presented in these meetings, or during this meeting.
Yeah, so tomorrow, and I think one piece of feedback we definitely got so I did share with all the council members and their constituent services folks, the information about these town halls. They were excited to get the word out. When one piece of feedback I have gotten is that we gave folks even more notice in advance. They'd be able to do, and this is particularly from some of the grassroots groups, but others as well. I'm sure if we gave them a little more notice, even more time for them to get the word out and communicate to people that they can participate. So excited about that. And we'll do more of it 2 weeks from now at our meeting. We'll do a little more of a substantive debrief and lift up some of the themes that we've heard. And also in 2 weeks, we will share some of the specific policy ideas that have come up. I've shared with all of you electronically a little while ago, and we'll post on the website a list, our running list of proposals that we've heard, and that's only the list I'm sharing with you is not even including what we've heard in these stakeholder sessions. So it's up to about 2 weeks ago. In the next couple of weeks, we'll add what we've heard and to that list, but we're well over 100 possible policy ideas, and we totally run the gamut from big ideas to relatively more rifle shot ideas from ideas that seem to me like, hey, this is a no-brainer, to ideas that seem to me like, I don't know, they're never gonna go for this, but what do I know? So we're gonna present it all, and we'll have some good conversations, really starting in about February, in September. I introduced myself by the wrong name the other day. That's how many of these meetings I've been. Just saying. I'm gonna share with you, this is the, I think,
It's a gotta get away moment.
something. So, yeah, so
I
this
was
is,
at a community meeting and I mixed up, it was a community meeting, I was welcoming these visitors to DC and they were beauticians. And I mixed up cosmetologists and cosmologists. And I was just waiting to get talking about how they were exploring the universe and they're all looking at me like, what the hell is. I'm saying to myself, they don't look like astronomers, but maybe.
Yeah, so we'll be talking about cosmology and cosmology. So this is what I've put together with Mike and Becky and Richard and Kim, thinking about from our perspective what we think would make sense for the next 3 months. So our thought is we'd have 2 meetings this month, 2 meetings in June, 2 meetings in July, Tuesday evenings as usual, and we'd hit the following topics. So today, tax comparisons and competitiveness. On the 16th, as I said, a review on the civic engagement process to date and lay out what we're looking at ahead. Then 2 important substantive topics. One, the topic of fees and fines, which we touched on a little bit last time, really digging in, of course, a fair amount of attention to how traffic enforcement fines are fitting into the revenue picture this time around in the budget context. Kim is really a national expert on this topic and will be sharing. She's like, I don't know about that. That's okay.
Little strong.
That's a little strong. For our purposes, you're a national expert and quickly be, and certainly by May 16th, you will be one.
Yes.
And as also, and Mike, with the help of some interns from University of Michigan, have been gathering some data on fees and fines here in the District of Columbia. So we'll be sharing some thinking there. And we're also going to talk about the concept of tax expenditures, which is just a fancy word for tax breaks, tax deductions, tax credits, and so on in the tax code. And I want to lift up some of the great work that actually already has been done in DC in ORA to spotlight them. And I think their work deserves more attention and can receive more attention in this process. And then the rest of the items on this list, I think, are I'm definitely very interested in having all of these fit into those following 4 weeks at a pace of 2 a week. 1 or 2 or maybe a little less definite than the others. We're going to circle back on the idea of a business activity tax, which we touched on briefly a number of months ago, with fleshing out what that really means, reminding us what we're actually talking about when we use that phrase, and considering a couple of fairly specific options. Potentially talking about, and Richard's going to get into this a little bit, but updating work that's been done on how hypothetical individual businesses might fare in the tax realm, whether they're located in DC, Maryland, or Virginia. That's what the case studies are. The topic that we've talked about a number of times, and we really, as Mayor Williams said in one of the stakeholder sessions, we need to look at some data on what's actually happening in terms of migration of individuals in the current era. So we're seeing what kind of data, what the most up-to-date data is that we can get out of the DZ tax system, and also what the latest research is saying around the country about tax sensitivity. A topic that's come up a bit has been how moderate and middle income taxpayers are facing in the tax. I know that in the deputy mayor's, when they were talking about the mayor's economic plan, I know that's a concern of theirs, is how do we continue to make the district a place for middle income families to grow and thrive. And how does the tax system fit into them? The hot issue of office to residential conversions is on the list. We want to talk about property tax rate issues and various, we've got a lot of property tax rates. And I think a lot of people put on the table a lot of different competing ideas about what direction they'd like to take various property tax rates. So we're going to look at some of those options. We've got, also earlier this year, we heard a brief presentation on how we address property tax relief for folks who have trouble or might find property taxes to be a pretty high cost expense relative to their incomes. We've got a number of programs in DC, and Adam Langley, who from Lincoln Land Institute in Boston, who gave that great presentation back in January, has agreed to do an even deeper dive with the help of some amazing new research coming out of ORA, and really think through what is this telling us about how we want to go on that front. And then, obviously we've heard a lot about, we heard, discussion about tax administration issues on Friday. Almost every almost every room we've been in, people have mentioned clean hands. Pretty much, Glenn was telling me the other day, every room he goes into, people mention clean hands. So, so Keith Richardson, from OTR has agreed to come talk to us, either in one of the June meetings and touch on that and other tax administration issues.
You know, even today, with Rich, I'd be interested in you sharing with us. This isn't like we're going to church, and I'm not criticizing church, but you know, I mean, if you're the preacher, you can make firm declarations about the next life, although you don't have real scientific data to back you up. Economists, they just make these, you read the Wall Street Journal editorial, they make these just flat out, like, territory judgments about this and that, but it's hard. There are a lot of variables, and I'd be appreciative. I think we all would, if you showed us kind of like the margin for error or the level of confidence, or you know, in the assertions you're making.
That's really good.
And the time frame.
Yeah, and the time frame too, because it changes over time. Like the mayor, and I'm not commenting one way or the other. The mayor says, "Well, we're going to have red light cameras." Well, is that red light? Is that the same revenue in year 4 as it is in year 1? Probably not, right? I mean, so how do these, like Jim's point, how do they change over time too? Yeah.
Yeah, and I think that's a really good plan. I think we want to present both a range of researchers, like, you know, researchers say different things, and so we want to be sharing that. So, and the other thing is that, you know, Yeshim's fond of, if Yeshim was here, she would be saying under what conditions, right? She's fond of that, and so, you know, under what conditions such thing.
So how are we gonna approach filtering 100, 200 ideas? To the mayor's point, there's a range of research and beliefs about the efficacy of a proposal or what it can do or how long it will take to do it. How are we gonna sift through that to get to a recommendation in an appropriate amount of time?
Yeah, so good question. So we'll take August off, by which I mean we won't have meetings in August. But Mike and I, Becky and Kim and Richard will continue to work so that in September, we're ready to go. And what we are doing is we're preparing essentially a huge library of 1 to 2 page summaries of policy ideas where we highlight the pros and cons. We're trying to figure out what is the best research to bring to you. And then we're just gonna start working through them as a body. And I wasn't around 10 years ago. I don't know if Mayor Williams or Richard, you want to speak to how you all made sense of dozens and dozens of proposals and got it down to something manageable. You want to say about how you envisioned?
In 2013, after similar to what you're doing now, had a series of meetings that had a large group of conversations. We then took the summer off, and as the staff put together memos on 63 policy proposals. I literally remember the number. I've been telling you. And then we put them into buckets. And we put those buckets by type of tax. And so we would have one meeting on all the ones related to the general sales tax, one on to property tax, and so on. And then as staff, my partner Steve Rosenthal and I would tee up a policy proposal. And all we would do is we'd go through it, explain the why, explain the goal, and then we turn it over to the commission. Kind of let all of you have your say. I like this. I hate this. I would never vote for a package with this in this. I won't vote for one if this isn't in it. And then there'd be no votes, talk it through. And that way, after we had then gone through all the proposals as staff, we then went back and said, and then started trying to mold that into a package by understanding where the support was, where the opposition was, and how are we actually gonna make this all fit together in a relatively revenue neutral proposal.
And it worked. So being in your seat, so I was a commissioner, I came in late, and we did it weekly, but we sat there and we talked. And there was some debate back and forth, and people generally were, respectful of each other, but talked about the things that they thought and made the points about why they thought something made sense and not. And I thought it went really well. Now, Mayor Williams, you were masterful at, herding the cats. we were, but, I think it actually worked way better than I would have imagined before we started the process.
Now, that discussion and dialogue, is it open to the public or is that, that's all of us open? Okay. That's what I was asking last week.
Would it be useful to think about, in terms of the commission and its subcommittees, for instance, other than real property tax, less than something else? Would it make any sense when these proposals come in that we have subgroups in the commission to I mean,
And we did, like, we had a low-income subgroup, which I led, which basically meant that I ended up meeting with Ed Lazier, who's at DC Fiscal Policy Institute, and Teresa Hines, who runs the DC cash. And partly that was helpful because we probably went through like all sorts of permutations of what you could do to the income tax. And it helped that we could then look at how, if you raise rates or lower rates, increase this credit versus not, it meant that we could go through that, and we worked really closely with ORA to do that. And I thought that was helpful to have a smaller group, and then we talked through it at the bigger meeting.
Yes, but I actually do not remember when your work started relative to the conversation on the policy proposal.
Like,
So yeah, my assumption and even possible recommendation would be have the discussion out in the open first, find the pressure points, so that then when you create a smaller group of experts to go into this, you kind of know what you're being bound by on the larger group.
and this is where ORA was terrific. And it also helped that I could stress test some, right? So this is where using the ORA data is actually really helpful because that's actual real data. But in what we were doing, I could use the TPC model and do some of it in-house to see whether there were other things going on. Now, in, full disclosure, we came up with what we thought was a good package, and then the federal government opted and totally changed.
Yeah, that happens. Yeah, and the other nice thing is that ORA will have more bandwidth to help us once we get through the budget.
Yeah.
But Jim, and I would, at the same time, I think as we start digging into real estate, like you saying that is really helpful, because we'll start pulling you in periodically and keeping you more abreast of some of what we're talking about. Thank you. Might even set up something like that sooner.
Just ask if we did something like committees that we made it sort of folks got to elect where they, as many as they want to be part of, because I have a feeling folks like me and Yeshem are going to want to be in like all of them potentially. So I want to make sure like everybody gets to participate where they want to participate.
So the one thing I would really use from all of you, and then we'll start in our main attraction, but between now and 2 weeks from now, if you would, take a look at these documents I've shared with you and think about what's jumping out at you as really important, what you really care about, but even more important, what's not on the list here that you wish was, because I'm sure we've missed something. Either we just haven't talked about it at all, or we talked about it, we just failed to put it on the list. And, but getting that out into the open between now and sort of, June, July, will make sure we're much more prepared when we go into September. All right. Now on to our main presentation on tax comparisons and competitiveness. Do you want, Becky, do you think, should Richard move down here so he's closer to the speaker, or should we move the speaker closer to him?
Erica, can you hear okay when Richard
I
talks?
think as close as the speakers can get to the speaker is better. Sorry to make y'all move, if that means moving.
Maybe
It's
just
just, it's a little in and out with the owl.
Yeah.
There we go.
Yeah, the more you at it, it seems happier.
I'm happy
Thank
to
you.
take the 10 steps it took.
But the one thing I'll say is, seeing this up is that Richard did the yeoman's work in boiling down a huge amount of information into what we think is hopefully digestible. You all will have questions, others, and I know we don't have, a few key people are not in the room, so I'm sure people will look at the slide deck and come up with questions. That's fine, that's good, that's normal, we're prepared to dig in, to provide additional answers at the same time, as I'm sure Richard will say. Some questions we may have are just not answerable, so.
But do you want to take questions during the presentation or save it?
What do you want to do?
I'm happy to do as they arise.
Can we wait till the end so that everybody gets a fair shot at asking questions? Is that okay?
Absolutely. All right, well, thank you, Nick, and thank you to the full commission. As I said last time here, it's an honor to be a part of these conversations and to do it officially now as partners with the commission. As Nick said, what I want to do, you can tee it up and go to the next slide, is go through some tax comparisons. And so I'm going to quickly run through some of the major taxes in the district tax system to show how it compares to its neighbors and nationally. And throughout this presentation, I'm going to try to use the word relatively every other second, because the only comparisons we can make are the district relative to other governments. I'm not here to make value judgments. I will not say this is good or bad. I will simply lay it out in terms of how it relates compared to these other governments. Then, after going through the district system, I'll briefly go over how tax comparisons and tax competition affect policy goals. As Mayor Williams importantly reminded you, competition is one of the objectives of this commission. But of course, it's not just competitions for competition's sake. We are doing this to serve other policy goals that we can achieve to ensure that tax policy aligns with the district reform that is best to achieve those. And then finally, I'm going to talk a little bit about reflecting on comparisons and competition. I'm very much trained not to make conclusions, and I will not. My goal is to provide you with the evidence and knowledge that will shape these conversations as we go forward, so you can make better arguments and you can deliver the points you want to make as you debate various policy options. Okay, so how does the district's tax system compare? And so, of course, as a budget nerd, I'm going to delay the actual thing you want to see and start with this very nerdy chart. This is a chart from a report we did at the Tax Policy Center a few years ago about tax revenue capacity and spending expenditure need. I start this out with this slide because I just want to interject before I get to everything that economic and demographic factors are a big part of comparisons. And what this chart is showing, you can see DC is circled on the far right. On the x-axis, you have a state's tax capacity. That is its ability to raise revenue. What we did is we created like an average tax system and gave it to every state and said who would then raise the most revenue, and it's DC. That's because DC has a heavy concentration of high-income people and high-value property. Now, I would love to say it's because the district is the greatest place in the world with the greatest people and the greatest property, mostly because it's a city. There's lots of other places that have high concentrations of high-income people and high valuable property, but they also have suburbs. They also have, rural areas. And so something that, again, absolutely. Something, again, that will come up again and again. This is the next slide. It's sometimes difficult to compare DC. We're going to do the best we can. But the districts, you were there 2 seconds. The district has high capacity. It's the highest capacity. It also has very high, what we call spending need. Again, if we gave every state the same expenditure system, like who would spend the most based on the things that they need to take care of. And DC has relatively high need on places like on par with California and Mississippi because it has, most importantly, a high concentration of a low income population, which would require it to, even if we took policy decisions out of it, spend a good amount on education, spend a good amount on healthcare. So that's just to say, a place where this always manifests is on, like, when we talk about per capita income. And sometimes people will use that to say district's off the charts. And it's like, yes, because the district is a city, because there's a high concentration of these things. And so this is something we should always keep in mind. Something important to note, Maryland and Virginia, similar to DC, have relatively high capacity. They got lots of rich people that help them pay taxes. They have average need. They have less responsibilities. Now, obviously, like policy choices are incredibly important, but this is where we start, and different places have different responsibilities and different building blocks how we get there. This next,
How does city, state, and local fit into this? Isn't that complicated now?
I mean, it would be great if we were able to show the district versus New York City, San Francisco, and pile all this together. But it just the work that will require to extrapolate it from those places, so we can make assumptions about them. But what most places do, and what we relied on in this presentation, are those state aggregations that are always going to kind of not, like a lot of places will purposely exclude the district because they'll say, I'll get to one where it's not apples to apples. That doesn't mean you can't learn something from it, but it means that you should always be cognizant of the differences that are built into these different places.
Could you do that without, a city name, but the comparable identification of population? Where there's high income population, one, and high property tax, and you said has a great need. And in relativity, what other places may look like that?
I think what's challenging is that, so a state like New York or California,
Just take a city.
but that city gets a lot of its revenue from the state. And so the people that live in San Francisco send their dollars to Sacramento. And then Sacramento then sends some of those dollars back to, and so they can't, so that cycle makes it difficult to track where the comings and goings are.
But if we took it before it was sent back, let's say, to San Francisco, and we looked at what was being produced, could we get closer to an apple to apple?
I mean, Kim, I've not seen a study that has done this.
So the closest is we've seen, so Minnesota does this and the district has done it, where they haven't done where they take all the money and all the need. What they'll do is say, this is what the taxes that are paid in case studies for families that look like this. The part that's hard is in a lot of these places, like New York City would be the quintessential example. Like if you could just say, what is New York City doing? And how much is it spending and can it spend on its poor people? Because it has all these rich people, that would be sort of something that you would think would be similar to the district. The problem is, and if you talk to people in New York City and if you talk to their office, their biggest complaint is the fact that New York State takes its money and doesn't necessarily give it back to them. You know, if we think about things, New York City and New York State keep having these lawsuits about whether they're giving enough money to fund education in New York City. And it's because the way the rules are set up, they are not getting that money back, right? So it's going into New York State. And then even though they have tremendous need, the formulas aren't giving them the same amount of money back. So I think you can do some of this, but it gets hard because kind of like in the federal system, you know, the district in California and New York are giving income tax money that's then going to other poorer states. We're seeing that especially in some of these large states, that the money is coming in, but then it's going out to more rural areas.
And just as a reminder, we were gonna save the questions
Yeah.
for.
Y'all are just excited.
Oh, it's-
All right. This next slide, and I promise they'll get to the fun stuff after this, is showing you how the District of Columbia, state governments, local governments, and then combined state and local governments collect their revenue, excluding federal transfers. So only owns those revenue. And so if you look at the District of Columbia, that top bar, it doesn't look like it's states. It's not a state. It collects all that revenue from property taxes that states don't collect. If you want to compare District of Columbia to other cities, that's going to be really difficult because look at that red bar, that's income taxes. Most cities cannot collect income taxes. The District of Columbia's bar looks most like the bottom bar when you push those two together. That is inherently going to make comparisons challenging, but it's also worth noting that's an incredible opportunity for the people in this room. If you were on the Virginia Tax Revision Commission, you would only be dealing with that state bar. If you were on the Richmond Tax Revision Commission, you'd only be dealing with that local bar. The District of Columbia gets to use and manipulate all these taxes. And as Kim was saying, push that out into its public services, not send it to the state, who then is going to make a different, decisions by different political leaders. It is worth though noting, if you look at the District of Columbia, that top bar, That blue and that red is property and income taxes. And it accounts for more than 60% of its own source revenue, which is a good deal more than the average state and locality. But again, that is both a reflection of policy choices, but also that the district is full of high value property and high income residents that allow it to collect that level of revenue from those sources. Okay, now to the stuff you actually came here for. Comparisons of tax rates. Let's start with business tax rates and tax rates on high income earners. These are relatively high. Again, there's that word, relatively. If you look at the top individual income tax rate, which I think for DC starts at 1 million, it is now 10.75%. That is notably higher than the top tax rate in Virginia at 5.75, and in Maryland, where the top rate is 8.95 if we include the local county sales tax. It is not the highest. California has the highest at 13.3. It's also not the lowest. The lowest is 0. Beating them there, you got to go all the way to 0, as I think 9 states now have no income tax.
So this was hold on.
Okay. The district's corporate income tax is on par with Maryland, and that's a change that came from the last tax revision commission, where it's now 8.25%. It's above Virginia, but it's in the ballpark at 6%. The highest corporate income tax rate is 9.8% in Minnesota. And again, there are other states that have 0, although huge asterisks that I should have put up there. A lot of those states have gross receipts taxes or other ways of collecting taxes, so where that 0 is not representative of its actual business environment. Here's the one I'm guessing you want to talk about: commercial property tax rate. The top rate for the district, which is 1.89 on property valued above 10 million, is significantly higher than its neighbors in Virginia at 1.55. I think I used Arlington, and 1.09. That's per $100 of value. Put all this together, and you look at the Tax Foundation, which is a right-leaning organization that advocates for lower taxes on business. The district does not score well on their business tax climate index. Again, this is tricky because, again, they're using states. And so it's not fair to put all the districts in, but I think the district has high taxes on businesses is a true statement. Specifically, the commercial property tax, and this is where we're going to get a little nerdy, and so stick with me. If you look at the district's effective commercial property tax rate, that is what you are paying compared to the value of your property. Actually, middle of the pack for states, for cities across the country. For what the company pays divided by the value of its property, that percentage, that effective rate of how much it's paying, that is relatively in the middle of the country for major cities. But that is a function of 2 things. One, places with low property tax values. For example, in Detroit, that effective rate is really high. That's just because those properties are low. So any kind of tax is going to create a high rate. And then there are other places, for example, like Des Moines, Iowa, where they are just incredibly dependent on commercial property taxes. And so that's what drives there. So we'll get to this when we talk about residential too. The dollars paid is high relative to other places, but the effective rate is in the middle. So it's going to be challenging to go through what the place is actually paying and what they are paying as a share of their tax base.
And is part of that assessment?
No, I think that is just really valuable property in the District of Columbia. It means we'll give them comparisons. You're going to get high taxes. Okay, let's try to do this for middle income households. Relatively speaking, the rates are kind of in the ballpark. In contrast to the commercial, the rate on residential property is low in the District of Columbia, 0.85 cents per $100 of value. It's higher in Virginia, 1.026. I'm using Arlington again, and higher in Maryland, 1.091, using Montgomery County. The individual income tax rate, this is challenging because this gets into what you call a middle income family, but the district has these rates at 6.5 and 8.5, where depending on your income, you're either close to where Virginia is at 5.75 or close to where Maryland is at around 8%, again, accounting for the local taxes. And then what really, makes this competitive, another change that was a result of the DC Tax Revision Commission and Congress, the district standard deduction is the highest in the country. This is, of course, when you do your taxes, you take the standard deduction, you get to knock amount of income off what you actually owe tax on. District standard deduction is significantly higher than it is in Virginia and in Maryland. And so even if those rates are comparable, a lot of families, if you're thinking a family that makes around $40,000, they're getting to knock a lot of money off of their tax bill before those rates even apply as a result. Anytime we're talking middle income families, it's worth noting Virginia levies a car tax that is going to add to that family's tax burden. And the district also has a relatively large homestead deduction, which operates like a standard deduction, which will knock value off a residential property tax. So if you look at national studies, DC's the rate on what they are paying, again, like as a share of the home, is low. The tax they paid divided by the value of the home, that is low. But the payment is still high. So this goes to the next part. This is where I think a lot of debates about property tax in the district can get people talking past each other. So this is from a Lincoln Institute study. This is the gentleman that presented on property taxes. We'll come back again. They're a great organization. If you look at tax rate, again, that's doing that, like, what did you pay divided by how much your house is? And when you do that, DC is a good deal. You're toward the lowest in the country. But because your house is worth so much, you are still paying a lot. So that's why your tax bill compared to these other places is high. And so this is where I think a lot of people could sometimes argue, we do a lot of things, and like, so actually you're not paying that much, but someone who actually is writing that check is going, what are you talking about? I just cut this check. And so depending on how you want to look at it, whereas compared to, like, let's not pick on cities, but they're up there, Detroit, Buffalo, the share of the home that is being taxed is relatively high. The value of that home is low. And so the check that they're sending to the government is relatively, low when it comes down to it. And so a big part of this conversation, especially when we talk about property, is the value of the property is a big driver on what residents are paying and how this reflects in comparing to other jurisdictions. Okay, now for relatively low income households. The district absolutely has relatively progressive policies. It has the largest earned income tax credit in the nation. This is the credit that goes to working families, mostly, or I would say, the largest checks go to, mothers with children, or parents with children, I should say, excuse me. But that largely goes to single mothers with children, where it is a share of the federal credit. And because the district's percentage is 70%, the district is sometimes sending, when they do their taxes, they're getting a rebate of $1,000, which is going in addition to the thousands that they're possibly getting from the federal government. In a lot of other states, the EIT for the state may be a few $100s. The district's EITC is meaningful, and it's soon going to go to 100%. By far the largest. It's much larger than Virginia, 15%. Maryland's is pretty good, but that's a recent development. Now theirs is close to 50%. The district also has a very beneficial property tax circuit breaker. This is when you go to do your income taxes, if you meet income requirements and property tax or rent payment requirements, you can get a tax rebate from the government. Kim and I are volunteer tax preparers. And every time we help a resident of the District of Columbia, we know to automatically look for this because we know that this is going to be a valuable tax rebate that they have earned and they can come from. Whereas when they come in and they're from Virginia and from Maryland, we know probably not getting anything. Very narrow program that's not doing anything to help them with the property taxes in those states. When you tie it together, ITEP, which is a left-leaning organization that advocates for progressive policies, specifically for low income and people of color, they rank the district second only behind California. But of course, this is before, I think, the district's recent EITC changes. But again, it's just also worth noting, again, I don't want to say it's good and bad. I'm just saying relative. A lot of other states do nothing for their low income residents. And so when the district is first, some of that's a low bar. That's not taking anyone from the great work that's been done, but it's also to say that, if we look at other places, something is going to beat nothing. And so a good job is going to beat nothing by a lot. And so this is kind of what I'm talking about, where if you look at state and local taxes nationally, we talk about regressive taxes. That's because, as ITEP is showing, it is the people in the lowest quintile, the lowest 20%, that as a share of their income are paying the highest share of their taxes. And then that goes down. That is because most state and local governments rely heavily on consumption taxes, on general sales taxes, which take a greater share from lower income households. Whereas in the district, you get one, that dip at the beginning, and then that's the great work that's been done on the earned income tax credit and the circuit breakers, which lowers the burden for low income residents. And then you get this relatively flat distribution of how people are paying. And that also goes into other decisions the districts have made. For example, when we were sitting here in 2013, there used to be a hump in the middle where there's this spike. And that's why we instituted the changes to the standard deduction and to the tax rates to make sure that we could flatten that out. But again, this is all before recent changes to both the EITC and to the top income tax rate that could be affecting those bars at the far right. But again, in general, the takeaway is the district system is different than most state and local tax systems. Okay, to get into some specifics, ORA has done studies, case studies, where they break down hypothetical families. Every study requires assumptions. Everyone is different, but this hopefully gives us a high level idea of how the district's tax system interacts with, quote unquote, average families. And what they find is that, for families earning $25,000 through $150,000, the tax burden is lowest in the District of Columbia. For those at the far left earning $25,000, this is where the EITC is doing a lot of great work. It's where the circuit breaker is helping these families have lower payments. So it should jump out that if you're earning roughly $25,000, your tax payment is roughly $1,500 in the district. It's over $4,000 in Virginia, because Virginia doesn't have those policies that lower those tax burdens on low income residents. They can affect them because they're paying sales, they're paying property, they're not getting the help that you're getting in the District of Columbia. And even if you go up to $100,000, $150,000, the households are still paying less, mostly because, again, the rate on residential property is relatively low. Of course, if we looked at the 15% of households who earn above $150,000, you would start to see the district eclipse these other jurisdictions, because eventually, as you earn more and more and more, those top income tax rates start to become a bigger, factor in your payments. And also, if you earn that much money, you probably earn a very valuable home. You probably pay a lot of money to your property tax bill. So again, the idea is that different families pay different taxes, care about different taxes, and that even this is overgeneralizing because different people have different circumstances. But again, roughly.
We're not supposed to, hold my question.
So, okay. To get you even more riled up, we'll now do the ORA study of businesses. This is for a recent study looking at tax year 2020. They looked at a small firm with 1.5 million in gross receipts and a firm 30 million. The 1.5 million firm is there because that's the median earnings of a business. The 30 million firm is there because that represents roughly a fifth of all firms, but that fifth who pays over half of the business taxes. This is looking at the major taxes: property, corporate income, unemployment insurance. I'm forgetting one, but it is not, as I underlined and read, taking account of the payroll tax. In both of these case studies, again, which involve a lot of assumptions, including just assuming that this is a professional service firm, the district firm pays the most. This is largely driven by the fact that there are higher property values in the district, combined with the higher tax rate on commercial property, means that there is a higher tax burden. So if you go to the next slide, you can see this very well, where green is property tax. And you can see that if I could snap my fingers and take away commercial property taxes, the district's taxes would be very competitive with these other places. There's the property tax that is a function of the high tax rate, but again, it is also a function of the very high valuable property pre-pandemic in the District of Columbia that is driving the difference in, affecting what these firms pay. I also did mention this doesn't include the paid family leave payroll tax. If you read the report, I encourage you to, it's very good. It would tell you that's because other businesses in these other jurisdictions either do so because they think it's good for business, or because, like in Montgomery County, there's a requirement that you have to get private. So they think this is more apple to apples, but it's worth noting the tax is significant. It would add, for example, a good amount of money onto the tax burden of the District of Columbia. Okay, so now that we got through that, we're close to wrapping up so we can get to the questions. I just wanted to make a few, hopefully, table setter comments for these conversations. Largely, when we talk about competition for families, for residents, we have this idea of migration. that this is going to affect where people go. And, organizations like the Tax Foundation that advocate for lower taxes are very quick to point out that if you looked at a map of where people are moving, it would overlay well of a map of states with no income tax or low income tax. That is true. It's also worth noting that those states have a few other things going on for them. They are warm, they are low cost. Arizona, Florida, Texas. You might imagine why someone might want to move there other than taxes. I kind of talk to sometimes people, like reporters from West Virginia, and I'm like, do you think taxes is the only difference between West Virginia and Florida? So there's always other things going on to this. It's also worth going, like, to that point, there are a lot of states with low income taxes that are not seeing growth, that are seeing population declines. Indiana, Kansas, Ohio, very low individual income taxes, negative population growth. Also, if we think about, who moves, low income households are generally more likely to move than high income households. And those states that a lot of people champion as low tax, they call them that because they are low tax for rich people. They are often very high tax for low income people because these states don't have earned income tax credits and they have very high sales taxes. So a lot of low income tax people moving to these states are actually moving to places that do not have, very auspicious tax systems for them. This gets into larger points that, like, while taxes are absolutely a thing that can motivate someone to move, you also have jobs, housing, family, and all sorts of other things. One huge asterisk, we're dealing entirely at this moment with pre-pandemic data. Something that Kim is going to work on is getting you post-pandemic data so that can be a part of your conversations. And if facts change, if the data change, we can incorporate that into our conversation and how we think about this, because we know that this is obviously a huge thing that could have affected how people think about this. Okay. And then, so that's for like households, kind of like similar story for businesses and growth. Again, like taxes are absolutely a factor, but let's think of all the other things that are factors. And this is where it gets complicated. If you typically ask a business about, where they're going to go, they're going to say things like access to customers, workforce development, transportation options. However, largely those are questions about the region you want to move to. And so someone could very well say, I want to move to the Washington metro region because I think this is going to be a good idea for my business. But what place they actually pick, taxes might come into that, because we're all in the Washington metro region, and now you've made that decision. Now you're having a more narrow decision. But again, something that is just hard to get across in these, again, I found the ORA study really good. All these studies and all these comparisons of tax rates, you kind of have to assume, you literally have to assume two firms. That's not the real world. In the real world, there are myriad different firms with myriad different number of employees, desires for office space, products that they need to move, eligibility for tax credits that are going to affect their actual tax calculation and their actual tax burden, which comes to, just for what it's worth, my thoughts on how we can possibly shape our conversations going forward about this. First, a note on 2013, we had a lot of conversations about reducing commercial property taxes in 2013 because we had the same data about property tax rates and payments that you do now, but it was really hard. It cost a lot of money, and it was going to be very challenging for us to get that down to where we are, again, what we did. However, we did recommend reducing the corporate income tax rate from 9.975% to 8.25%. We decided that because A, it was a relatively affordable tax cut. B, this was able to put DC on par with its neighbors. And C, we thought it was a signal to businesses that just was serious about presenting a tax system that was inviting to businesses to stay and grow here. Another thing, as I mentioned, we focused heavily on middle income families. So again, we saw that bump, and we thought we could do something with that. On both, we wanted it to help everyone, but we thought that there was some real, bang for the buck, that we can make changes on here that were affordable for the district's overall revenue system, but that would have, very large positive outcomes as a result of those changes. And then finally, just like some last thoughts. Or no, I have slides left. Again, just like the limits of this. It's again, a lot of this is driven by the value of property. And taxes are possibly going to be a policy goal here, but they might not be the best one. So it's a good example of thinking through what are we actually trying to change and how are we going to change it? Is tax the right, or are there other things in the government's toolkit that we can use? Also, as always, a lot of the things that are uncompetitive about DC, like its taxes on high earners, allow it to be competitive for other people. For example, families get access to early childhood education and paid family leave, which could be attractive for one people, even though it's unattractive for another. And then just like the thing that we always include these things about hard tax reform is, just because you tell someone that they have a comparatively low tax burden and you're going to increase their taxes, still a tax hike. Still really hard to get them to admit to it, no matter how many graphs you show them, telling them that, no, don't worry, we promise you it's comparatively low. And that you could cut taxes for one group and still leave them with a comparatively high tax rate, but could still leave them, not feeling as accomplished the goal you wanted. So my hope is that this will help you have these conversations. It will help shape your conversations about larger policy goals. But again, let's start with the policy goals and then understand how taxes affect it and how lowering or making them more competitive that you do that. Again, I think these comparisons are valuable, but they all have to make assumptions. We have to deal with actual firms and actual results when considering policy changes. So what I like to just think about, when you talk about policy, we're talking about competition, who are we trying to serve, who are we trying to attract, who are we trying to retain? Thank you.
Okay, so let's start with just a couple of questions. So are we actually showing a migration of high earners or not? Or do we know yet?
We don't know yet. So what I'm hoping to do, and I'm having a conversation that's settling later this week. There's a study in California where what they did is they used information about people who changed their from resident to non-resident tax paying. So I'm hoping if we have some information on that, tied with something like the American Community Survey, we might be able to get some information about whether people have changed where they are. I don't know whether we can do that with DC's taxes. It's just trying to figure out how we answer questions like this post-pandemic gets tough because, when somebody talks about what is the, level of uncertainty or the margin of error on any of this, it's gonna be high because there's so much uncertainty about this. But part of it is, we know what we know about what drives migration or not pre-pandemic. What I'm trying to do and what we're gonna try and do is try and figure out whether we can say anything about what's going on post-pandemic. Like, we kind of know that in general, people don't primarily migrate because of taxes. They do it for a host of reasons and they move to different places.
So a lot of it's cost of living and housing. So I would move, housing's so important. I would move to a state that may be regressive to me in other ways if the housing's a lot cheaper, because that's a big deal, right?
Anecdotally, yeah. I mean, I think that
Yeah.
because it comes into that, I mean, if you just, this isn't based on a report I've read, but I think if you're sitting down to do the math, the first thing you're gonna do is what's the home cost?
But
Then you're gonna do those other.
then the final question, how much of the, you talked about how revenue capacity doesn't really compensate for geographical differences, like, one state has deserts and farmland and we don't. But how much of this is accommodated distortion of the tax base? So for example, California has a high income tax rate. Could that be because of Proposition 13, that they jacked it up to compensate for Proposition 13? Okay,
That's simplistic, but yes, California is.
okay, so let me finish. So, and that if you looked at DC, it's like looking at my plane. If you only looked at one side, you say, well, your engine's overheating, it's running really hot because my other engine doesn't work. If half of DC's tax base is off limits, we're definitely gonna be redlining the other half.
Yes.
How much is that included in here? The distortion of our tax base.
Because of the inability to tax certain property
Right, and
and
the inability to tax commuters. And
I think it's tough. I mean, the textbook answer is the broader your tax base, the lower your rates. And
right,
so if we were able to tax commuters, we would not have to have, if we were able to tax more property, we would not have to tax that.
so that's, so I don't wanna take up everybody's time.
Yeah.
But if there were some kind of like a scenario where you could say, if we had no congressional limits on our taxing authority, here's what the rates would look like. I would just be interested in that.
Like, I don't think it is a coincidence that the district has a high tax rate on commercial property and the district is limited from doing things. Now, that's history. This gets into why it's, this was built up over a long period of time. And then similarly speaking to your point, like, one of the reasons you have high rates on high income earners is because there's a whole part of your base that's not there. But that doesn't, to get to capacity, DC still has a lot of very valuable property and a lot of rich folks. Yeah.
You made a point, maybe, if we had a community tax, commercial rates could go down, to be competitive or more than competitive.
Okay, so
I mean, if we had oil like North Dakota has underneath that, you'll get into a certain amount of ifs.
You said that the district's tax rate related to, or not a tax rate, but tax revenue related to the need of spending on low income for health care. The earned income tax credit work in there, and I don't want to, not our whole talk about the output, but if we spend all this money on this area, output, what do we get it for it? And does that, to any degree, relate to taxes?
So are you okay? Sorry.
Yeah, different.
Right, so the capacity and need studies, they're using sort of average things across states as their rates. I think what we do know with something like the earned income tax credit, and what we have evidence from even nationally, when the child tax credit was larger last year, is it's pretty effective at getting people out of poverty. And so part of it has to do with your goals. And so if what you're trying to do is do something like, lower the poverty rate, and it doesn't show up directly in the poverty rate because of how we calculate things, but it helps people do that, which is why I think in general, people have been more reliant on the earned income tax credit. There's also the exciting part that, some people can think of it as a tax cut, and some people can think of it as a spending program, which can align people with different philosophies behind it.
So I would just add that when you're talking about comparisons, there's two things to keep in mind. There's the level of revenue, and then there's how you're getting that revenue and who you're getting it from. Maybe a good way to think about this is to think of a state like Colorado. Colorado has relatively low expenditure need. It has a relatively high income population, has a relatively young population. So that means they're not spending a lot of money on healthcare and education just because of who they are. As a result, they're able to keep their total down, but they still make decisions about who they want to pay. And as opposed to the district, now again, like not getting into conversations about policy decisions and how we want to do this and the effectiveness of it, that there's just a built-in that it's got to take more, relatively speaking, than Colorado because of what it looks like. But that's separate from how the district then decides to cut it up and repay. And so the earned income tax credit is a way to ensure that the lower income population isn't overburdened by the total amount it's spending on by, slapping, like, say, for example, like the district could collect the same amount of revenue, but do it by having a really high sales tax and not having an EITC. And that would totally shift who is paying, but it wouldn't change how much it's bringing in.
If all we bring people out of poverty with this, anybody?
Yeah.
Yeah. I mean, if on one hand, it's more theoretical than real, we're saying that happened. On the other hand, we have high property taxes, a high cost of property to get into houses, Columbia. I mean, do they cancel out or that's what's going on?
it's kind of like we're moving toward the target, but we're moving the target.
I don't know what.
I mean, we are lifting, in a technical sense, we're lifting people's incomes above the poverty line. And, there's a lot of research that says, compared to not having earned income tax credit at all, that's good for their kids' long-term outcomes because the families are more stable during middle school. But yeah, the kids are growing up in a hard, tougher economy. I mean, all of our kids are struggling with rising costs of housing and job market. It's really tough for a lot of people. It's, so we're not fixing the whole economy.
Erica.
Well, I mean, if you look at the supplemental poverty rate in the district, ours has sort of not budged, and a lot of that is about housing costs and other kinds of cost of living expenses. Of course, things would be much worse if we weren't doing the things we're doing, but we're doing a lot of great things. I think actually it speaks back to Richard's sort of opening, which is that we are a place of extremes where we have a concentration of folks that earn really high incomes and do really, really well. And then we also have a lot of folks and a concentration of folks who are mostly Black and brown people in the city who experience poverty and a lot of disadvantage and don't have access to everything our economy has to offer other folks. And I have a couple questions if I can jump in. Is that okay? Okay. I thought one thing I'm wondering, Richard and Kim, is if we can get some kind of comparison of effective tax rates. I mean, ITEP does this, of course, by quintile, but there might be other ways to slice it. And I wonder if that's something you all can provide. I mean, Richard, as you said, rates are one thing. We also have a really high standard deduction when it comes to like our income tax. So effective tax rate, so basically the actual taxes you pay over income seem like a better way to think about how we compare to other places than just tax rates, which, ours can look very high, but may not have a similar, may not have as big an effect as people might think because it's based on sort of a lower taxable income, right? So I'm wondering about that. I'm also wondering about the usefulness, and we had DemPed come and present some rankings from, I think, Arizona State University or maybe someplace else in Arizona, but I'm wondering about the utility of even thinking about rankings on based on taxes. What does it mean when Tax Foundation says we're like one of the worst, but Wyoming is number one and followed by South Dakota and Alaska? And are these, I start to question, what are our real goals here? I mean, we're not trying to be Wyoming or South Dakota. They may be places experiencing sort of high levels of growth relative to where they started, but we're a very different place. And we're not trying to be like those places. So I question that. I'm wondering also, and someone asked Catherine Landfield asked in the chat, whether we can compare our property tax rate and the taxes paid relative to Silver Spring or Baltimore, or Arlington, Richmond, other places that are nearby. Because, yes, we may pay more in property taxes nominally, but we also gain a lot more too in terms of value of our property. There's real wealth creation here in the district that isn't necessarily there in other places. So those are just some questions I have in terms of inquiries we can follow and things we could flesh out a little bit more when we're talking about this. And I'll just lift up one other question in the chat, which is that the presentation didn't tie any of the data to actual metrics of competitiveness. And so I wonder if you want to try and do that. I mean, these are how our tax rates and tax, quote unquote, burdens compare. But what's the link there to competitiveness? Because I think that, it's worth drawing that out.
And I would just say that in part, it depends what you mean by competitiveness and who you're talking about. So part of this, especially when we talk about businesses, And whether a place is competitive for business to locate there has to do with a lot more than just taxes. And so, it's, I think it's just thorny, especially when we're talking about new businesses or different types of businesses. Often, especially for new businesses, they're not earning money, so they're not paying taxes. So it's sort of, when you're thinking about business creation and job creation, in other work we've done, we found that there are other ways that are more effective than, say, lowering tax rates in terms of setting up things like incubators and helping places get business loans if they need, you know, help sort of setting up their activities or something. So I guess my question is, I'm not sure what they need, like competitiveness, like.
Well, I mean, look, if
Well, maybe we should say what we mean by competitiveness. Like, what are you all talking about in this presentation by when you're saying competitiveness? And that might help. And then we can think about whether we want a broader definition that we should start looking at.
So first of all, my definition is not the commission's definition, and that is something that you are going to have to decide over the course of your conversations and kind of pulling this diverse group together. What I wanted to present to you were mostly the rates, because the way I think about this when I go through this is, again, to link this to policy goals. It would be great if there was just this competitive matrix, and that when we wanted to make a decision, we would see where we ranked on the competitive matrix and pulled the lever and moved it up and down. We can't do that. So what we can do, though, is decide that our policy goal is, attracting this specific type of business, or ensuring that this type of family is allowed or able to remain in the District of Columbia. And then looking at what taxes most affect them, and then looking at where the district ranks on things like tax rates to try and give you an idea of whether it is out of sync with other jurisdictions, in particular competitors. Does that help?
And then the other thing.
I mean, I think so, but I do think there's just and I agree, we should probably define those things. I've heard a lot, we've all heard, those of us who've been at these public engagements have heard a lot from small business about, and last night we heard this at the ARC in Ward 8 about, the small businesses that are truly micro small businesses that don't have any access to really anything, probably also aren't paying much in taxes. So if we're thinking about tax policy for competitiveness where we are growing those micro businesses and creating the conditions where they can thrive, that is a very different conversation than whether or not the big multi-state corporations that are operating in the district feel like, I get a good deal in the district compared to other states. I just think those are very different conversations. So it's anyway.
No, I really understand.
You're right, Richard. But I think that it makes it hard for people to understand what this conversation really is.
And not to completely fail at my job, but I would hope that they would consider that it's challenging. I would rather them do that than just smack the tax foundation's ranking down and be like Wyoming, call it a day. I hope that they would go through and talk about, well, if you're a small firm, you don't pay commercial corporate income tax. So what do you care about? You care about what is the.
Well, we're not Congress or the city
Yeah.
council, so we're not debating our preferences.
Mm-hmm.
But that said, nobody here is saying we should be Wyoming or Alaska.
Yeah. But I think the point that Erica is kind of
We're
making.
talking about competitive blue, not junk blue to red. You know what I'm saying?
Right. But that is why I would again encourage you to think through the goals and then work backwards on the taxes and start pulling out what taxes are important and then looking where the instead of going in the other way and saying, oh, you're
I
ranking.
think all these questions, like from Erica, and I had a couple questions to Jim, I think are all good.
Mm-hmm.
Would help us inform further discussion.
No, I was just gonna say the point about what you said before about commuter taxes versus commercial property taxes. If you only have one lever to
You're
get
gonna yank on
money
it.
for business owners
Yeah.
that are not physically in the district, then it's gonna make it really tough to figure out how you're gonna lower that and still recognize the fact that you might want people who are commuting and setting up their businesses in the district to pay their fair share, however that gets defined. And so I feel like that was a really valid point, that some of this gets tough because of the limits that are in place. Like California, has high income taxes in part because Prop 13 limits how big its property tax can be.
I want to just make sure, Rashad, Glenn, Carolyn, guys, jump in.
Just a couple of observations on the competitiveness discussion we just had, and I think, maybe Erica was getting to this point, you were getting to this point too. The chart showed these relative amounts of tax paid by the $30 million business and the $150 million business. The question that comes to mind is to what extent that price differential makes a difference in location, because it wasn't in some respects, the gap was not significant between us and the next one down, perhaps the one below that. And so when we talk about like what will create a competitive environment for business, I think we do have to define competitiveness more than just the tax rate and figure out what other inducements or location-based decisions make a difference to locating. And ease of the tax system maybe, or access to particular kinds of workers, even though we're in the region, it still makes a difference whether you work in Tyson's or DC versus proximity. So we gotta, I think, figure that out. And I wouldn't want us, not to suggest we would, but as we start deliberating decisions, looking at just the tax rates or tax burden as the marker for making a decision, what should be up or down, was my first observation. The second, in the $25,000 to $150,000 range of earnings, and that tax rate being fairly competitive, I think context is important there too, because someone who earns 25 to 150 in the district is competitive because I think part of the answer was that the tax burden, that their tax burden is lower, but those people can't afford to buy homes here, right? And so that's that's kind of out of sync with the benefit that we think of for a lower income earning DC resident. It really isn't, because they move elsewhere because they can't buy, or they rent here because they can't buy. And I think we've got to think about that as we think about the burden on the lower income residents.
All of that, I think it's important though, in terms of wealth building and access in the district. And there's no reason to doubt what he's saying. If you make $125,000, still buy the District of Columbia. So I don't know what we recommend that, but that's the reality of it. You have that problem.
But really, Richard made a point, but you made it pretty quickly, and I think it's a really important one and a really subtle one. When you're looking at those business comparisons, the reason DC is even a little higher than other places is because, so you've got this sort of example firm, right? In DC, it's paying this amount, like it's got a certain amount of gross receipts, a certain amount of employment, spending on employees. But in this example, its real estate bill is much larger. It's paying a lot more for rent, and that's why it's paying more for property taxes. But, the accountants sort of do these typical firms, and they say, well, this firm in DC, they've got this really big real estate bill, therefore they're paying more taxes. Over here, we're imagining a firm in Loudoun or wherever, and they're paying a lot less for real estate. Okay, they're paying a lot less for real estate, and therefore the property tax bill is less. But that means they're not really comparable. I mean, a firm in Loudoun that's paying a little bit for real estate is not really comparable with a firm in DC. And in fact, the real measure of competitiveness is the market. What is the market telling you about where that firm wants to be? Well, the market is demanding much higher rents in the district. So arguably, the firm in the district, even though it's paying a little more in taxes, is getting a lot more for what it's paying. And you see that, what the economists call revealed preferences, what they're willing to pay in rent, so it makes those comparisons really hard, and that's why, as you say, you know, what we need to see from the data that Kim's gonna get, and from other data is what is the behavioral response? It doesn't really matter, sort of, in the end, what the comparisons are only the beginning of the story, what matters is what's the behavioral response, and what do you actually, if you have your taxes a little bit higher, what are you losing, and how much do you value what you're losing? You know, if you're losing families who can't afford to buy here, maybe that's a big problem.
Well, it's kind of like saying, you know, I'm gonna go to the store with the lowest price for the oranges. Well, nobody really shops like that. It's really, I'm gonna go, I like a certain kind of store, and as long as the price is right for what a bundle of goods at that store, lighting, the quality, the music, whatever, I'm gonna go to that store. I'm not gonna stop going to the store if the price goes up a little bit, but if the price goes up and the place gets dirty and da, then I leave. And to me, my notion is it's a bundle. People make a decision, the cost of housing, maybe I am running a business, not so much the taxes, but, you know, I'm gonna go to the right to work state because this labor is cheaper, you know?
Well, the mayor's question about the out migration of the taxes. Indication where we really know that. There's anecdotal evidence. And two, is there a way, I don't ask for, to get the federal match on that? I mean, could you put on your federal tax, what state you pay?
That, so we have summary information on that, but that is further behind. Like, when I'm hoping, and again, I will know more hopefully after Thursday or Friday, when I talk about what might be possible, or we can have a side conversation. Like, ideally, what I'm hoping to see is whether there's information that might give us some indication for whether people sort of changed their status, in how they're reporting. Like, but part of this is also the part that's really hard, and it is gonna be hard, and nothing I say or we come up with is gonna be definitive, in that we're in the middle of things playing out. Like, we're not at the new steady state yet. So anything we can say is sort of what people did, say, between 2019 and 2020 and maybe 2021. But do we know if 2025 or 2026 is gonna look like that? No. Like, we don't know what's going on. And there is some indication that at least some businesses, as the economy is softening, are actually demanding people come back into the office. And so, to the extent that we move from something where we're now in this sort of period where, like, workers have more, relatively more power, and so there's sort of push and pull about whether people can work from home or not, that's gonna affect how this is all gonna play out. So what we're trying to do is figure out what information we can get and what we can learn about what we see right now.
I like the mayor's analogy of stores and selling. Like, there is like anecdotal evidence, there's some anecdotal evidence that people move to Maine. We're moving to Maine for taxes, they're moving, you know, it's like, well, Maine's not even selling oranges, they're selling wine, so don't beat yourself up about the cost of oranges, figure out your competitors and what they're doing. And this gets to Erica's point about having the conversation about where do we think the district needs to compete and compete better. And hopefully you can use these, you know, rates and like other data to inform those conversations.
Well, yeah, we have different views. Yes, yeah, I think it's good.
Right. Thank you so much, Richard. This is super helpful, great presentation. I think you gave us a lot to chew over, a lot to think about. I do think, as you take this away and chew it over, it's fair game to come back and say, well, what about this? You know, how do we stack up in this store? How would this typical family, Erica made a couple of suggestions along those lines. You know, we do have the ability to do more comparisons in the coming months, so we'll come back to us with those questions. And with that note, I think we're done. Cool. All right, see you all.
Thanks, you all. Thanks, Richard and Kim.
stakeholder meetings tomorrow. Back here.
Right.